Namaskar students. Hope you are hale and hearty, taking care of your health and your studies. Before starting today's session, I would like to ask you a simple riddle. It's a kind of poem. What is that thing which makes all of us run? In order to accumulate it, we lose all the fun. It doesn't even matter if it is shady or sunny. We see everyone around us bothered about it, be that papa or mummy. Yes, you got it right. It's money, money, and money. Yes, that's the topic of our discussion today. Money and Credit, chapter number 3 from your economics books, Understanding Economics of class 10. Money and its journey in India goes way back. Starting from cowrie shells found abundantly in the Indian Ocean were among the earliest forms of currency used in world. In India, they were colloquially referred to as cowrie and were used in certain areas like Odisha even until early 1800s. The first documented instance of coins being used as currency in India dates back to the 7th or 6th century BC. These punch marked coins were stamped bars of metal, usually copper and silver, and that were the first issued in Mahajanpada kingdom of the Indian Iron Age, and they lasted until the end of the imperial Mauryan period. The Indo Greek kings then introduced new types of coins that would influence Indian coinage for many centuries to come. The Kushan Empire, which existed from the 1st to 3rd century Common Era, began minting gold coins which featured mythological deities. The Gupta Empire from 320 to 470 Common Era produced the largest number of gold coins in Indian history, which is why it is often referred to as the Golden Period. Coins continued to take on various forms through the subsequent dynasties in India, from the Rajput and Mughal Empire in the north to the Maratha and Vijayanagar kingdoms in the south. It was actually Sher Shah Suri who, during his 5-year rule from 1540 to 1545, introduced the nation to a new currency which is the ancestor of the modern day rupee. After defeating Humayun and taking over the Mughal Empire in 1540, Suri set up a new civic and military administration that issued a silver coin termed as Rupaya, which remained in circulation even during the remainder of the Mughal period, as well as during the Maratha era. The Rupaya remained the dominant standard currency even during the British Raj, despite the East India Company's efforts to introduce the sterling pound in India as early as in 1600s, but the coins issued in Western India, especially in Bombay and Surat, and South India, which was Madras provinces, differed from their northern counterparts in both design and metallurgy. The issuance of a uniform coinage in India was brought about only in early 19th century when the English, who were now the dominant power in country, enacted the Coinage Act of 1835. The newly designed coins saw the traditional Indian images and symbols replaced with the effigy of King William IV, which was itself replaced by the portrait of Queen Victoria from 1840 onwards. However, it was only after the Indian Rebellion of 1857, also known as Sepoy Mutiny, that the British declared the rupee as the official currency of colonial India. So, when cash was crowned the king, Coins initially derived their value from the precious metal used to mint them. This posed a problem for the sovereigns who did not possess the requisite gold or silver to prevent a drastic devaluation of their currency. Paper money solved this problem as it bore a promise to pay its possessor the equivalent value of gold or silver from the public treasury. Soon, it no longer mattered that paper money was not backed by anything of tangible value, and it was simply accepted as a medium of exchange currency. Modern forms of money include currency, paper notes, and coins. Unlike the things that were used as money earlier, modern currency is not made of precious metals such as gold, silver, or copper, and unlike grain and cattle that are neither of everyday use. The modern currency is without any use of its own. Then, why is it accepted as a medium of exchange? It is accepted as a medium of exchange because the currency is authorized by the government of the country. In India, the Reserve Bank of India issues currency notes on the behalf of central government. As per Indian law, no other individual or organization is allowed to issue the currency, as we have discussed early in the evolution of money in India. Moreover, the law legalizes the use of rupee as a medium of payment that cannot be refused in settling transactions in India. No individual in India can legally refuse a payment mode in rupees. Hence, the rupee is widely accepted as a medium of exchange. Deposits with banks, the other form in which people hold money, is as deposits with the bank. At a point of time, people need only some currency for their day to day needs. For instance, workers who receive their salaries at the end of each month have extra cash at the beginning of the month. What do people do with the extra cash? They deposit in the bank by opening a bank account in their name. Banks accept the deposit and also pay an amount as an interest on the deposit. In this way, people's money is safe with the banks and it earns an amount as interest. People who have the provision to withdraw the money as and when they require, since the deposit in the bank accounts can be withdrawn on the demand. Thus, these deposits are called demand deposits. Demand deposits offer another interesting facility. It is the facility which lends it the essential characteristic of money, that of medium of exchange. You would have heard of payments which are made. Thus, we see that demand deposits share the essential feature of money. The facility of checks against demand deposit makes it possible to directly settle payment with the use of cash. Since demand deposits are accepted widely as a means of payment along with currency, they constitute money in the modern economy. Payments are made by checks instead of cash. For payment through check, the payer who has an account with the bank makes out a check for a specific amount. A check is a paper instructing the bank to pay a specific amount for the person's account to the person in whose name the check has been issued. So, let us take the story of banks further. What do the banks do with the deposits which they accept from the public? There's an interesting mechanism at work here. Banks keep only a small proportion of their deposits as cash with themselves. For example, banks in India these days hold about 15% of their deposits as cash. This is kept as provision to pay the depositors who might come to withdraw money from the bank on any given day. Since on any particular day only some of its many depositors come to withdraw cash, the bank is able to manage with this cash. Banks use the major portion of the deposits to extend loans. There is a huge demand for loans for various economic activities. We shall read more about this in the following sections. Banks make use of the deposits to meet the loan requirements of the people. In this way, banks mediate between those who have surplus funds, which are depositors, and those who are in need of these funds, the borrowers. Banks charge a higher interest rate on the loans than what they offer on the deposits. The difference between what is charged from the borrower and what is paid to the depositor is their main source of income. We have seen in the above examples that people obtain loans for various sources. The various types of loans can be conveniently grouped as formal sector loan and informal sector loans. Among the former are loans from the banks and cooperatives. The informal lenders include money lenders, traders, employers, relatives, and friends. In the graph 1 given in your books, you can see the various sources of credit to rural household in India. It is more credit coming from the formal sector or the informal sector. The Reserve Bank of India supervises the functioning of formal sources of loans. For instance, we have seen that the banks maintain a minimum cash balance out of the deposits they receive. The RBI monitors the banks in actually maintaining the cash balance. Similarly, the RBI sees that the banks give loans not just to profit making business and traders but also to small cultivators, small scale industries to small borrowers. Periodically, banks have to submit information to the RBI on how much they are lending, to whom, at what interest rate. There is no organization which supervises the credit activities of lenders in the informal sector. They can lend at whatever interest rate they choose. There is no one to stop them from using unfair means to get there. There is no organization which supervises the credit activities of the lenders in the informal sector. They can lend at whatever interest rate they choose. There is no one to stop them from using unfair means to get their money back. Compared to the formal lenders, most of the informal lenders charge a much higher interest on the loans. Thus, the cost to the borrower of informal loans is much higher. Higher cost of borrowing means a larger part of the earning of the borrower is used to repay the loan. Hence, borrowers have less income left for themselves, as we saw for Shyamal in the Sonpur, the stories which are given in your books. In certain cases, the high interest rate for borrowing can mean that the amount to be repaid is greater than the income of the borrower. This could lead to increasing debt and the debt trap. Also, people who might wish to start an enterprise by borrowing may not do so because of the high cost of the borrowing. For these reasons, banks and cooperative societies need to lend more. This would lead to higher incomes, and many people could then borrow cheaply for a variety of needs. They could grow crops, do business, set up small scale industries. They could set up new industries or trades in the goods. Cheap and affordable credit is crucial for the country's development. Formal and informal credit. So, who gets what? The graph 2 shows the importance of formal and informal sources of credit for people in urban areas, like we discussed earlier. The people are divided into four groups from poor to rich, as shown in the figure. You can see that 85% of the loans taken by the poor household in the urban areas are from informal sources, which is a huge number. Compare this with the rich urban households. What do you find? Only 10% of their loans are from informal sources, while 90% are from formal sources. A similar pattern is also found in the rural areas. The rich households are availing cheap credit from formal lenders, whereas the poor household have to pay a large amount for borrowing. What does all this suggest? First, the formal sector still meets only about half of the total credit needs of the rural people. The remaining credit needs are met from informal sources. Most loans from informal lenders carry a very high interest rate and do little to increase the income of the borrower. Thus, it is necessary that the banks and cooperatives increase their lending, particularly in the rural areas, so that the dependence on informal sources of credit reduces. Secondly, while formal sector loans need to expand, it is also necessary that everyone receives these loans. At present, it is the richer household who receive formal credit, whereas the poor have to depend on the informal sources. It is important that the formal credit is distributed more equally so that the poor can benefit from the cheaper loans. Now, we'll talk about some self help groups which are exclusively for the poor. In the previous section, we have seen that the poor household are still dependent on the informal sources of credit. Why is it? Banks are not present everywhere in rural area. Even when they are present, getting a loan from bank is much more difficult than taking a loan from informal source. As we saw for Megha, the story which is there in your books. The bank loans require proper documents and collaterals. Absence of collateral is one of the major reasons which prevents the poor from getting bank loans. Informal lenders, such as money lenders, on the other hand, know the borrower personally and hence are often willing to give a loan without collaterals. The borrowers can, if necessary, approach the money lenders even without repaying their earlier loans. However, the money lender charges a very high rate of interest and keeps no record of the transaction and harass the poor people. In recent years, people have tried out some newer ways of providing loans to the poor. The idea is to organize rural poor, in particular women, into small self help groups, which are also known as SHG. Small help group has 15 to 20 members, usually belonging to one neighborhood, who meet and save regularly. Saving per member varies from 25 to rupees 100 or more, depending on the ability of the people to save. Members can take small loans from the group itself to meet their needs. The group charges interest on these loans, but this is still less than what the moneylenders charge. After a year or two, if the group is regular in saving, it becomes eligible for availing loan from the bank. Loan is sanctioned in the name of the group and is meant to create self-employment opportunities for the members. For instance, small loans are provided to the members for releasing mortgaged lands, for meeting working capital needs, buying seeds, fertilizers, raw materials like bamboo and cloth, for housing material, for acquiring assets like sewing machine, handlooms, cattle, etc. Most of the important decisions regarding the saving and loan activities are taken by the group members. The group decides as regards the loan to be granted, the purpose, amount, interest to be charged, repayment schedule. After it is the group which is responsible for the repayment of the loan. Any case of non-repayment of loan by any one member is followed up seriously by other members in the group. Because of this feature, banks are willing to lend to the poor women when organized in self-help groups, even though they have no collateral as such. Thus, the self help groups help borrowers overcome the problem of lack of collateral. They can get timely loans for a variety of purposes and at reasonable interest rates. Moreover, self help groups are the building blocks of organization of the rural poor. Not only does it help women to become financially self reliant, the regular meeting of the group provides a platform to discuss and to act on a variety of social issues such as health, nutrition, domestic violence, etc. We must notice that the Grameen Bank of Bangladesh is one of the biggest success stories in reaching the poor to meet their credit needs at a very reasonable rate. Now, let's take up some important terminology in relation to the bank and the banking system. Talking about repo rate, it is the rate at which the Central Bank of India, which is Reserve Bank of India, lends money to the commercial banks in the event of any shortfall of funds. Bank rate. Bank rate is the rate charged by the central bank, which is RBI, for lending funds to the commercial banks. Bank rate influence lending rates of commercial banks. Base rate is the minimum rate set up by the Reserve Bank of India, below which banks are not allowed to lend to its customers. Banks lend in two ways. Either they lend directly to the banks. Over here, we can directly see that the bank lends the money to the banks. Reverse repo rate is the rate at which the central bank of the country, which is RBI, borrows money from the commercial bank within the country. It is a monetary policy instrument which can be used to control the money supply in the country. Reverse repo rate is the rate at which the central bank of the country, which is RBI, borrows money from the commercial bank within the country. It is a monetary policy instrument which can be used to control the money supply in the country. The call money rate is the interest rate on a type of short-term loan that banks give to the brokers, who in turn lend the money to the investors to fund margin accounts for both broker and the investor. This type of loan does not have a set repayment schedule and must be repaid on demand. The investor who owns the margin account pays their broker the call money rate plus a service fee in turn for using the margin capabilities offered by the broker. The reserve requirement is a central bank regulation that sets the minimum amount of reserves that must be held by a commercial bank. The minimum reserve is generally determined by the central bank, which in India is again Reserve Bank of India, and it is to be no less than a specified percentage of amount of deposit liabilities the commercial bank owes to its customers. In India, the statutory liquidity ratio SLR is the government term for the reserve requirement that commercial banks are required to maintain in form of cash, gold reserve, PSU bonds and Reserve Bank of India approved securities before providing credit to the customer. The SLR to be maintained by a bank is determined by the RBI in order to control the expansion. Banks play an important role in the economy for offering a service for people wishing to save. Banks also play an important role in offering finance to businesses who wish to invest and expand. These loans and business investments are important for enabling economic growth. Hope you learned a lot about money today and the credit and various systems attached to it. Let's try to analyze how much have we accumulated in the form of knowledge from this chapter. Let's do it. Okay, let's do some question answers. So, who issues the currency notes in India? Your options are: currency notes are issued by the Finance Commission, all the nationalized banks can issue the currency notes, only Reserve Bank of India can issue currency notes, any individual or organization can issue currency notes with the permission of the government. Yes, it is option number 3rd. Only Reserve Bank of India can issue currency notes. Moving on, an agreement which the lender supplies the borrower with money, goods or services in return for the promise of future payment refers to debt, deposit, credit or collateral. It is credit. Which among the following options will be the cheapest source of credit in rural areas? Bank, cooperative society, money lenders or finance company? Very right, it is cooperative society. In which country is the Grameen Bank meeting the credit needs of over 6 million poor people? Bhutan, Sri Lanka, Bangladesh or Nepal? Very right, it is Bangladesh. Which of the following is not an informal source of credit? Money lender, relative and friends, commercial banks or traders? Correct. Commercial banks are not an informal source of credit. I hope you liked this video. We'll be back with another video with new facts and figures. Till then, stay safe, stay healthy, and keep studying. Namaskar.